This is Betty Meredith, President of the Retirement Resource Center, a retirement education and training company for financial professionals, clients, and consumers. I'm happy to be your host today for Situational Social Security with Jim Blair and Mark Kiner of the National Social Security Association. There are 76 million baby boomers, and each has a unique Social Security situation. Some are single, some are married, some divorced, some are surviving spouses, children, public employees, and some can still file the restricted application. However, most advisors are not familiar with Social Security options for the wide range of situations among their clients due to lack of education. And our speakers today dedicate their time to helping advisors and consumers make informed decisions with what is Americans' largest cornerstone retirement asset, Social Security. Jim Blair is co-founder of the National Social Security Advisor Certificate Program, and he spent 35 years with the Social Security Administration as a service representative, then a claims representative taking claims for retirement, survivor, disability, and health insurance, then as an operations supervisor, and then district manager. Mark Kiner is a CPA with 30 years experience in public accounting. And his primary areas of service were to privately held businesses and individuals. But then he recognized a need in the marketplace for enhanced advisor knowledge for Social Security filings, so he sold his practice in 2012 to concentrate on Social Security. Mark is co-founder with Jim Blair of the National Social Security Advisor Certificate Program. And the certificate program received accreditation from the Institute in Credentialing Excellence, ICE, in December 2017. It is the only accredited Social Security program in the nation. And I have to say, this is a big honor. I know what they had to go through to get this done. And when you are accredited, that means that your program is top notch. So Mark provides Social Security consulting and education services and empowers advisors and clients to take control and maximize Social Security benefits, which is why they're here today talking about situational Social Security. So thanks, Mark and Jim, for being here today. We'll now turn it over to you.
Thank you so much, Betty. I'm Mark Kiner. I'm the person on the left. Jim Blair is my partner. As Betty indicated, well, first of all, we're both located in Cincinnati, Ohio, and I'm a CPA. Sold my practice in 2012, so I can concentrate 100% of my time in the Social Security space. Jim worked for the Social Security Administration for 35 years. Jim, talk about what you did for SSA, please.
Sure. I worked there for 35 years, as Mark mentioned, and I did a number of jobs while I was there. Started off as a service representative. That's the smiling face you see when you walk in the front door. Of course, that's when you can walk in the front door, right? You're probably aware, but you can't visit probably any government office at the moment. And we're expecting that to last probably through the end of this fiscal year, maybe around October 1st. We got our fingers crossed those open back up to the public. But the service representatives generally help people who have already applied for benefits. They have a check problem. They're missing the check, or the amount was wrong. Maybe they've been overpaid. All sorts of things that service representatives deal with. Did that for a few years, moved into the claims taking part of it, became a claims representative, took claims for retirement, survivors, disability, and health insurance. And after 10 years of doing that, I moved into the management end of it and did a few jobs there, but spent the last 9 years as the district manager of the Piqua, Ohio office. You may not know where Piqua, Ohio is. It's about 30 miles north of Dayton, Ohio. But the nice thing here, and what this kind of points out, is that the Social Security Administration is probably the most accessible government office out there once they open up again. And wherever you are, there's probably one fairly close.
I just want you all to know that us being on this webinar today, it's just a matter of fate. Let me tell you how Jim and I met and got together. As a CPA, I was getting more and more questions about Social Security. I did not know who to go to for answers. So I thought I would offer Social Security consulting services in my accounting practice. So back in 2008, I bought 3 books, read them cover to cover. I ended up with more questions than answers. Social Security is difficult to learn from a book. There are just so many types of benefits you're eligible for and different percentages of benefits that you'd be eligible for. So I knew I could not offer Social Security consulting services in my accounting practice. So one day I was at lunch at a Rusty Bucket restaurant, similar to a TGIF nationwide. An attorney walked in, somebody I'd known for about 10 years. On a hunch, I went up to him and I said, "Do you know anybody who can educate me about Social Security?" Well, he told me he has this uncle that works for the Social Security Administration, and his uncle's retired a few months later. Well, you all know by now his uncle ended up being my partner, Jim Blair. Jim was not eager to go into business with me at first, were you, Jim?
No, I had plans on retiring, doing nothing, and just going fishing.
But we did get together and went into business together in January 2010. At that time, our focus was to help folks to understand and maximize their benefits. And then we evolved to an education company in 2013 when we started the National Social Security Advisor Certificate Program. It's an 8-hour class, and we talk about Social Security from 8 o'clock in the morning to 4:30 in the afternoon. But believe me, folks, we have a blast. Anyway, bios about who we are. Just so you know, I have to kind of give a little disclaimer. These pictures are about 10 years old. Our head of marketing continues to suggest that we update our pictures. But I say, well, we're not looking for dates. So anyway, we've kept these pictures in our PowerPoint for probably longer than we should have. What? Oh, Jim, go for it.
Yeah, and the learning objectives for today, hopefully you will learn about the various types of Social Security benefits. There are several types of benefits that the Social Security Administration pays out. You're going to learn about the options that people have, married couples, divorced couples. We call it situational Social Security, but each couple or individual has their own distinct options available to them that they need to know about. We're going to look at the options for surviving spouses. They have options other folks don't have. Of course, that means they have a deceased spouse in their past, and they have different ways they can apply for benefits. And there's other types of clients that you have out there that you'll be wanting to make sure that when they file for Social Security, they're doing that in the way that's most advantageous to them. You're going to understand the questions and issues that relate to these clients, because they're going to ask you questions about Social Security, and you will understand that Social Security is the universal language of the baby boomers out there, and how it can help you connect with them, because you know that it's always on the baby boomers' minds. Even the youngest of the baby boomers are getting awful darn close, and they're starting to think about that retirement stuff. So they have a language all their own when they talk about Social Security.
And Jim mentioned 3 words that we emphasize during our 8-hour class, but we're going to emphasize today. And those 3 words are situational Social Security. We are contributing authors to this book, 2021 Social Security Medicare Facts Book, published by the National Underwriter Company. Almost 1,000 questions, over 700 pages on Social Security, Medicare, Medicaid, and related topics. It's a great resource. Folks that go through our program can buy this book at a 35% discount, bringing it down to about $150 or so. It is a good resource for advisors that always need to look up answers to questions about Social Security. And don't forget, you got the holidays coming up. What better way to say I love you to your significant other than buying them a copy of the 2021 Social Security Medicare Facts Book? I know it does wonders for my relationship. It would do wonders for yours. Jim?
Yeah, the program, you can see, has certainly grown over time. It was passed into law in 1935, but it took a couple years for payments to be made. And the first year that we saw payments was in 1937. We have 52,000 people receiving benefits, and they received $1,278,000 in benefits. That was retirement back then. And while that may not sound like a whole lot now, I'm sure it was a lot of money back in 1937, but still, If we look at 2019, so far that's the last year we have statistics for, we had 64 million beneficiaries, people receiving benefits, and the Social Security Administration just in 2019 paid out over $1 trillion. It was $1,048,000,000,000 in benefits that they paid out. That's a lot of money. So we expect that just to continue to grow over time. If you'll notice, since the year 2000, the number of beneficiaries increased by about 19 million people, but the amount of money paid out way more than doubled. Went from 407 billion to over $1 trillion in payments. So it's a huge program. It's important for a lot of people, and it's something that folks are going to need to depend on when they do retire.
This is a huge program. 64 million folks receive monthly benefits. $1,048,000,000,000 in benefits were paid out in 2019. It is huge. Go down to the bottom of this slide. The 1939 amendments provided for benefits to be paid out in monthly checks. Ida May, she was the first recipient of a monthly benefit. She began to receive $22.54 a month in January of 1940. She's my hero because she lived to the ripe old age of 100. So the first lesson of this hour is that Social Security will pay you for as long as you're alive. They'll never call you up and say, Mr. or Mrs. Jones, your account is down to zero and your benefits stop next month. Jim, what's the average death age nowadays?
Well, if someone can make it into their 60s, according to the Social Security Administration, a male in his 60s has a life expectancy of right around age 84, and a female in her 60s has a life expectancy around age 87. Now, the other thing they tell us is that about half of those people can expect to live to their upper 80s, early 90s, and a quarter of those folks live to be 95 or older. Unfortunately, or maybe fortunately, they don't tell us which one of us those are, and people have to kind of figure it out on their own and take a look at their health and their family history and that kind of thing. But people are definitely, living longer. As if you can make it into your 60s, you have a real good shot of making it into your 80s. If you can make it into your 80s, you have a real good chance of making it into your 90s, and even some into their hundreds. So it is a lifetime benefit, and people are living longer, so it makes it even more important.
As a matter of fact, I look at the Cincinnati obituaries from time to time, not every day, but pretty close to it. And I'm seeing more people passing away after reaching age 90, and definitely some of them passing away after reaching age 100. But look at Ethel. Ethel is a friend of the family's. She's 106 years of age. The picture on the left is Ethel celebrating her 106th birthday. And the picture on the right is a picture of Ethel recently after getting a haircut. Now, not all of your clients will end up being Ethel. They're not going to live to the ripe old age of 106 or 107. However, your clients may be receiving benefits for 20, 30, or 40 years. I believe Ethel has been receiving benefits for 40 years, probably going back to maybe 1975 or so. So you really do need to help your clients to make a wise decision, help them to make a plan to maximize and understand their benefits, because there are very few opportunities to change your decision going forward. So, Jim, we emphasize situational Social Security throughout our class. And why don't you talk briefly about the first five, and I'll take the next four, please.
Well, folks, regardless of their situation, have different options available to them as to when they can start their benefits. Single folks probably have the fewest. We're looking at 62, full retirement age, maybe age 70, but definitely somewhere in that 8-year window. That's when everybody's going to apply, somewhere for retirement anyway, somewhere between age 62 and age 70. You can't file before 62, no reason to wait past 70. So single folks are looking at those points. Those are the main points, 62, full retirement age, and 70, but they could hit at any time that they wanted to apply for benefits. Married folks, we're looking at a lot of different scenarios. Are they close in age? Are they far apart in age? What are their earnings? Is one a high earner and the other one was a stay-at-home mom or dad? Or are they both high earners, or one's a high earner and the other a middle income? So there's all sorts of situations in there. And that's going to kind of control when each of them are going to start their Social Security benefits. In a lot of cases, we'll have public employees involved. In a lot of states, for instance, Ohio, our public employees opted out of Social Security. They had that option way back many years ago, and they opted out of Social Security. They have their own retirement program, but a lot of those folks are still eligible either for retirement or benefit off of someone else's work record. And that public employee pension is going to affect those benefits, those Social Security benefits. So we have to be able to talk to people about that and show them those changes. There's a term called restricted application, and this is real important for some folks. Now, not everybody's eligible for this, but if someone was born on January 1st of 1954 or earlier, they can take advantage of the restricted application. Now, I know these people are all now past full retirement age, but a lot of them are waiting till age 70. And what the restricted application will do is allow them to receive a monthly benefit payment while they're waiting to start their own, be it at age 70 or whatever age they're looking at. So those folks born by that date or earlier have this available to them, and it can be a great strategy for them. And then children can be involved. Could be minor children under the age of 18. Could be a child still in high school between 18 and 19, or, and this may be the one that's the most common, a disabled child. If this child was disabled before the age of 22, they are eligible to draw benefits off of their parent's work record, whether the parent's receiving retirement, disability, or that parent passed away. So there's all sorts of different benefits that can be payable out there.
Now you can see why I might have been a little confused reading the book I read. You've got so many different types of benefits that your clients may be eligible for. It's difficult to learn that from a book. Number 6 on this list, you may have clients that are divorced. They may be able to draw off of more than one ex-spouse, and they may be able to change from one ex to another. And we'll talk about ex-spouses over the next 40 minutes or so. Your clients may be surviving spouses. Maybe they can collect off of one or more deceased spouse or one or more deceased ex-spouses. There's an opportunity to receive a nice lump sum check. 6 months worth of retroactive benefits are available to folks after reaching full retirement age. So if you have a client that might be age 67 or 68, they can file for benefits effective 6 months ago and get a nice lump sum check. And full retirement age will range anywhere from 66 to 67. Your clients that are turning 62 this year in 2021, that means they were not married. That means they were born in 1959. And Jim, what would their full retirement age be?
Their full retirement age is actually 66 and 10 months.
And next year, your clients that are turning 62 next year means they were born in 1960. And their full retirement age is age 67. So COLA, the COLA adjustment that folks saw effective with the benefit received in January of 2021 was 1.3%. And you can see the COLA adjustments going back to 2010. We've had a few years of zero COLA adjustments, but we are expecting a pretty good sized COLA adjustment for folks when they receive a benefit payment in January 2022 of approximately 4%. You know, Jim, I was driving around town today. The gas station, $3.15 a gallon is what I saw. What are you saying?
I was seeing 315 and went down a little bit to like 309.
Yeah,
Woohoo!
it's amazing.
But I saw some gas price yesterday. I actually filled up. It was $2.77, but I was down near the Kentucky-Tennessee border, so
It's
it
almost
wasn't here in
worthwhile.
Cincinnati.
Hey, Jim, it's almost worthwhile going down there to fill up your tank. So,
Any excuse I've got to go down there, I will take.
so basically, we're expecting a decent sized inflation adjustment for folks in January of 2022 of about 4%. Let's look at some claiming trends. 1996, 56% of men and 63% of women began benefits at age 62. Let's fast forward to 2018. You can see the percentages have come down a lot, 27% for men and 31% for women. Jim, bring out your cloudy crystal ball. What do these figures look like going forward?
Well, we think maybe that the men will stay about the same. It's not that men don't want to retire at 62. I talk to people all the time and ask them, when do you want to retire? And they'll say, I want to retire today, but I can't afford it. So we think it'll probably stay about the same. You know, if we look back several years, as you can see, it was higher. If we go back in the 80s, it was probably in the 80% at 62. But folks are putting off retirement. Now, females, it's possible it could increase some. We think that as people learn that Social Security should be treated more as a household income, technically it's your personal income. You can file when you want to. Your spouse can file when they want to. You don't have to get anybody's permission to apply. But if you look at it as a household income, we may have scenarios. Here's one scenario we see a lot, and that is the female will file earlier, maybe as early as age 62, go ahead and take their benefit, but then that brings money into the household and allows the male to delay their benefits, maybe even to age 70, and get a higher monthly benefit amount. That not only brings overall more money into the household, but if survivor benefits are important in your couple's estate planning, generally speaking, so far the male's a higher earner, and the wife outlives him, so odds are she's going to receive his benefit upon his passing, and the longer he can wait, the higher that survivor benefit's going to be. So we may see the female number go up a little bit.
And if the husband was born by that magic birth date of January 1st of 1954, he can file to receive a spousal benefit off his wife but while at the same time he's earning those delayed retirement credits. That's what we call a restricted application, and we'll talk more about that in just a few minutes. So what are two big questions? How do you maximize benefits, which I'm going to talk about? But before we talk about that, Jim's going to talk about the solvency of the Social Security Trust Fund.
Yeah, and if you watch TV or listen to the radio, the Social Security's broke, so they don't have any money, and I guess nobody's going to get anything, at least according to the radio and TV pundits. But that's not true. Actually, so far every year, we don't know about 2020 yet. We're hoping those numbers will come out soon. But through 2019, every year, the Social Security Administration has had a surplus. They brought in more money than they paid out. And so they have about $2.9 trillion in U.S. Treasury bonds. And that's the key. But by law, they have to purchase these Treasury bonds. So 2.9 trillion, that's a lot of money. Will it be a deficit in 2020? If not, 2021? Well, eventually there will be, and they'll have to start cashing those in. But so far, so good. Wasn't much of a surplus in 2019, only 2.5 billion. Only when you talk about government stuff do you use the term only 2.5 billion. But they did have that surplus. And just to give you an idea, they brought in $1.061 trillion in income in 2019. Now, 945 billion of that was the FICA tax, the Social Security tax that people pay on their wages and in their self-employment. 36 billion of that was income tax that people pay on their Social Security benefits. So I guess if there's a silver lining to paying income tax, it's that the tax you pay on your Social Security benefit does go into the trust funds and helps make it a little more solvent. And then 81 billion was the interest on those treasury bonds. Well, they spent $1.059 trillion. We already talked about $1.048 trillion was the benefits paid out, and the rest was to administer the program. Social Security is kind of self-contained. It takes care of itself. They administer the program with the funds that they collect. The problem being, if you add the FICA and the income tax together, and don't include the interest, it doesn't cover what they spent. And we know that by 2035, that that 2.9 trillion dollar trust fund, or that treasury bonds that they have, they'll be gone, and we won't have that interest. So that's where the problem is going to come in. But that's
Jim,
where we're at so far.
Jim, do me a favor. We are expecting a few changes down the road. On the slide 14, name your top two, please.
Top two is going to be actually the top two. They're going to raise the full retirement age, I'm pretty sure. Currently, it caps out at 67. They're going to change that to 70. Now, who's that going to affect? Probably people in their 40s, 30s, and so on. Folks fairly close to retirement will keep their same full retirement age. Just to give you an idea, when they moved it from 65 to 67, the law passed in 83, and it didn't start moving for folks until 1990. And it's a 22-year process to get that accomplished. So I'm pretty sure they're going to raise it to 70, but they're also going to raise what we pay the Social Security tax on. This year, that caps out at 142,800 to make the programs almost solvent. They need to move the full retirement age to 70 and raise what you pay the tax on to around 240, 250,000. But those are definitely the top two.
How do you maximize your benefits or your clients? Number 6 on this list, the smiling faces, and do me a favor, visualize Jim Blair smiling. The smiling faces, the local office, or on the other end of that phone call, are basically just order takers. They're not there to give you advice or help guide you. They'll take your application once you made your decision. When Jim Blair worked for Social Security, there were about 85,000 employees. Now we're down to about 70,000. So a lot of people like Jim Blair, 35-year veterans, have walked out the door. So if they are not allowed to give you advice, then you need to help your clients to make a plan. Number 1 on this list, help them to make a plan to understand and to maximize their Social Security benefits. Please remember that Social Security may be a joint lifetime benefit. Generally, upon the passing of the husband, the wife will step into his shoes. If he took benefits early, that reduction will last 2 lifetimes. If he waits beyond full retirement age, all the way up to age 70, that increase may last 2 lifetimes also. Do not think inside the box. You have to think outside the box. Number 4, SSS stands for Situational Social Security. Can your clients file that restricted application? Are your clients single, married? Are they survivors? Are the kids involved? Are your clients divorced? How do you coordinate your client's spousal benefits? This is what we call thinking outside the box. This is the value that you can bring to your clients. Now, the restricted application we've talked about a couple of times. This must be in your Social Security toolbox. This is when you file for benefits off your spouse, while at the same time your benefits grow earning delayed retirement credits. So let's say that's my situation. Let's say I'm eligible for $2,000 off my work record. Let's also say I can get $1,000 off my wife. I can file a restricted application at my full retirement age, collect $1,000 a month, and then at age 70, I turn my benefits on, and now my benefits have grown by those delayed retirement credits from $2,000 to $2,640. It's like having your cake and eating it too. I've collected $48,000 in spousal benefits, and I've gotten those delayed retirement credits. So who would not utilize this strategy at full retirement age? Well, there's a magic birth date. You had been born by January 1st of 1954. If your clients were born by that date, then the restricted application needs to be in your client's Social Security strategies. So you need to know their birth dates. If you use software, you'll enter their birth date. But if you're just talking to them in general terms, make sure you know if they were born by that date. Because if they were born by 1/1/54, then the restricted application needs to be in the discussion. This 3-legged stool shows some of the strategies available for a married couple. Strategy number 1, leg number 1, we have one spouse waits to age 70. Now, that very well could be both, but generally it's going to be the husband. Jim, on a percentage basis, how many folks actually wait to age 70 to collect their benefits?
It's pretty low. It's about 4%.
So it's not like all of your clients are going to wait to age 70, but more of your clients than just the general public may wait to age 70. So for you guys and ladies, that percentage may be just a little higher. Leg number 3, maximizing surviving spouse benefits. So the later the husband can wait, anywhere from 66 to age 70, now we're maximizing surviving spouse benefits. And then leg number 2 is the coordination of spousal benefits, along with understanding situational Social Security. Jim, how many folks have online accounts? A few thousand?
A few thousand plus. This says 55 million, but I think it's 55 million in one, because I saw something the other day from Social Security that said over 55 million have online accounts, but they're still down that 55 million number.
It's a good exercise, isn't it? Isn't it, Jim, to have an online account?
I think everyone 18 or older should have this online account.
You know, if you don't have an online account, they will send you a paper statement beginning at age 60. It's fairly simple to create an online account. Just go to ssa.gov, click on My Social Security, give them some information about your driver's license, and presto, you've got an online account. The statement will show your benefit estimates at certain ages. It will also show your earnings history. So encourage all of your clients to set up online accounts, and we encourage all of you folks to set up online accounts. It's a really good exercise to do. Now, we're not going to go over all of our slides because we only have 50 minutes to talk and 10 minutes of Q&A. This slide is our full retirement age slide. It shows your full retirement age as a function of your year of birth. Folks are turning 62 this year. That means they were born in 1959, and their full retirement age is 66 and 10 months. You're going to meet with clients next year. They're turning 62 next year. They were born in 1960, and their full retirement age is 67. I was born in 1956. My full retirement age is 66 and 4 months, which equates to June of 2022. Jim, what's the significance of full retirement age?
Well, there's a couple things. That's the amount of your benefit. They're going to pay you 100% of what Social Security calls your PIA, primary insurance amount. That's 100% of your benefit. It's not reduced for age because you took benefits before full retirement age, but it's not increased either because you delayed past full retirement age. It's just 100% of your benefit. It establishes the date that if you say you wanted to retire this month and you're 62 or older, then they're going to use your full retirement age month and year to determine how many months early are you applying for benefits, which will tell us how much of a reduction you're going to see in your benefit amount. Also, if you delay past full retirement age, you earn delayed retirement credits. Your benefit's going to be increased. And the number of months would be determined by the number of months you wait past your full retirement age. And then one more important thing that it does is the full retirement age ends the annual earnings test. The earnings test applies to folks who want to take their Social Security benefits and also work who are under their full retirement age. But once you reach full retirement age, this earnings test will no longer apply to that individual, and they can work and earn as much as they want and still draw all of their Social Security benefits.
So my full retirement age is June of 2022. If I claim early, reduce for age. If I claim later, I get those delayed retirement credits. Jim, question for you. How many years do we look at when computing benefits? Let me give you 3 options. Last 3, 5, or 10 years. Highest 3, 5, or 10. Or 35. What's your thoughts?
We're going to go with number 3, 35. It's 35 years of earnings are used to compute your Social Security benefit.
We do something special to those earnings, Jim, don't we?
We do. It's called indexing. Social Security indexes those wages, and what that means is they adjust them for inflation. Indexing is Social Security's term for inflation. So they'll bring all those wages that you had in all those years, starting with that very first job you had at Wendy's or McDonald's, all the way through the year you attain age 59, they're going to apply an inflation factor to that. Now, that doesn't mean your earnings starting with the year you turn 60 aren't counted. They are. They just count them for whatever it is that you actually earned. But before that, they're going to increase those for inflation.
So if your clients earn maybe $20,000 in 1985, indexed amount today could be about $60,000. We're not going to go into detail on how benefits are calculated, but I want to leave you with this. The return on investment for paying FICA taxes, folks, generally very low, and many times it's zero. So don't assume that if your clients continue to work while they're receiving a benefit, that their benefits will go up. If they go up, it'll go up by pennies or dollars. They won't go up by a whole lot. So what's the good news about 35 years? Hey, missing a few, no big deal. You'll still get the bulk of your benefits. What's the bad news about 35 years? Well, we're going to look at your first job at Wendy's. Index those earnings for inflation. If they're high enough, they'll be included in the benefit calculation. This chart shows you the amount of benefit you'll receive at age 62. Your clients are turning 62 this year, means they were born in 1959. They would receive, if they were to begin at age 62, they would receive 70.8% of their benefits. I was born in 1956. If I would have begun at age 62 in February of 2018, I would have received 73.3% of my benefit. So, Jim, if somebody takes early, does their benefit go up to 100% at their full retirement age?
Wouldn't that be nice? But the answer is no. The whole point was if you take your benefit at 62, wait till full retirement age, or even wait till age 70, the amount of money you receive from Social Security on average should be about the same. Well, that might have been the case when they first came up with that theory, but they haven't kept up with it. So not so much. But no, once you take a reduced benefit, it is always reduced.
Thank you. Now, this is a very important topic. Anytime you're receiving a benefit prior to full retirement age, there's a limit as to how much you could earn before the nice smiling faces at the Social Security office will withhold your benefits. We call this the annual earnings test. And just briefly, at age 62, the annual earnings test is $18,960. And if for every $2 you earn over that amount, you lose $1 in benefits. And so you have to give consideration to what your client's earnings are. Now, the good news is this. If your clients lose benefits due to the earnings test, when they turn full retirement age, Social Security will recompute their benefits and give them more money each month. So the benefits withheld are not really lost. You do get that money back over time. This annual earnings test goes away the month that you turn full retirement age. So I turned full retirement age in June of 2022, and by magic, the earnings test goes away in that month. Did I say June or February? I think I said June. I think I said it right.
You said June. Yeah.
Okay. So if I begin in June of 2022, there's no earnings test at all because the earnings test goes away for me in that month, June of 2022. But the initial earnings test is close to 19,000. For every $2 you earn over that amount, the nice folks at the Social Security office will withhold $1 in benefits. So I want to remind you that we will answer questions during the last 10 minutes of our webinar today. Go ahead and type them into the chat box. I'm sure, Betty, you probably have 1,000 questions by now, but continue to type them in. Now, delayed retirement credits, if you wait beyond full retirement age, you get 8% more per year. So if I get $2,000 at my full retirement age, then at age 70, now I'll get $2,640. It's a 32% increase if your full retirement age is age 66. Jim, permanent or not?
Well, this is definitely permanent. So if you earn delayed retirement credits, you increase your Social Security benefit. And also, if your spouse is going to step into your shoes when you pass, you increase the survivor benefit as well.
You don't have to wait till your birthday to get 8% more. For each month you wait beyond full retirement age, your benefits go up by 2/3 of 1% per month. So if your full retirement age is 66 and you claim at 62, it's a 25% haircut. If your full retirement age is 66 and you wait to age 70, you get 32% more in delayed retirement credits. Waiting till age 70 from 62 is a 76% increase in your Social Security benefit. Can you imagine how many cups of coffee that will allow you to buy at Starbucks each month? Now, Betty, when you were introducing us, you must have said Social Security about 100 times in 4 minutes. That was a difficult thing to do, I'm sure. Now, in our class, we talked about spousal benefits. We spent about 45 minutes here. Spousal benefits is a main factor in deciding when to claim benefits. So for my wife to collect off my work record, she must be at least age 62. I must be receiving either a retirement or a disability benefit. So I could be receiving a disability benefit at age 55. And my wife, as long as she's age 62, can collect off my work record. So my wife must be 62, but I must be receiving a benefit. What if I want to wait to age 70 to get those delayed retirement credits? Then she has to wait until I'm 70 to turn my benefits on before she's eligible for a spousal benefit off my work record. Jim, are ex-spouse? Oh, no. Well, how much are spousal benefits, Jim? Is it 25% of PIA or something different?
It's 50% of the PIA. The PIA, the primary insurance amount, always equals what you would receive at your full retirement age. So if you're not sure what a PIA is, it's the same amount as your full retirement age benefit. But they're going to take 50% of the PIA and pay that to the spouse.
I was going to say, Jim, if you don't know what PIA is, take our class. That's what I would have said.
Yeah, that too.
Jim, talk briefly about divorce, folks.
There are divorced spouse benefits. And I will say that, speaking of our class, this is one of the most fun times. People get real excited. And when we would do seminars for the public, this is when everybody definitely woke up because it caught a lot of people's attention. There are a couple of categories of divorced spousal benefits. The first one, Social Security is going to want to know, are you single? So if you're married, you cannot draw off of your ex-spouse. But if your ex is married and you're not, you can still draw off of them. So are you single? You have to be at least age 62. You can be older, but 62 or older. You had to be married to your ex-spouse for 10 years or more. Now it has to be continuous, with the only exception being if you're divorced in 1 year and remarry that same person, and by the end of the following year, they'll disregard the divorce. But otherwise, it's got to be continuous. And your ex-spouse has to be receiving either a retirement or a disability Social Security benefit. Now, there's a second category called independently entitled divorced spouse. A lot of the requirements are the same. You still had to be single. You still had to be married to your ex for 10 years or more. But now both of you must be age 62 or older. And if you've been divorced for 2 years or longer, you can file on your ex-spouse's record, even though they haven't applied for Social Security benefits. So you could both be age 62, you meet all the requirements, but your ex is still working, has no intention of applying for Social Security benefits anytime in the near future. You could still draw off of their work record and receive an ex-spousal benefit.
I need to pass by some of these slides, folks. Don't have enough time. Jim, talk about surviving spouse benefits, please.
Yeah, there are widows, widowers, and surviving divorced spousal benefits that are payable. These benefits are payable as early as age 60. You take a 28.5% reduction if you file at age 60. It doesn't matter what your full retirement age is. You take that 28.5% reduction. It is actually possible to draw the widows and widowers and surviving divorced spouse benefits as early as age 50, but that is if you become disabled within 7 years of your spouse's death. And the 28.5% is still the maximum reduction. But if you wait till full retirement age, you'll receive 100%. Now we call it full benefit age. You'd have to take our class to find out why, but there is a difference between full retirement age for retirement and widows and widowers benefits.
I hope you, okay, I hope you guys have all realized something. Jim and I, we're having a blast. When we teach our class, I always say it's time to rock and roll. Social Security can be a dry topic. And believe me, folks, it is a dry topic. But what Jim and I try to do, we try to liven it up just a little bit and throw some jokes along the way. We pick on somebody all during our class. No, not somebody in the audience. Harold. Harold is with us all day long. He's a party animal and does not give the best advice. And for some odd reason, he gets mixed up with Darlene Snell from the Ozark Netflix series. And I always tell Harold, you better watch out. You better Google how Darlene's husband Jacob passed away. All right, we're going to move on, folks, and we're going to talk about some of the stuff that we do, because I know we have lots of questions here. Let's look at the key takeaways. Everyone's Social Security situation is unique and different. We want you to know the main rules and strategies for single folks, married, divorced, and surviving spouses. Understand the questions to ask to open up opportunities. You need to ask the right questions. The biggest question that we went over that you need to ask is, when were you born? By 1/1 of 54? Then you know the restricted app is available to you. That's number 3. Learn the language of baby boomers. Understand that if you want to connect with baby boomers, understand that Social Security is their universal language. And just remember, 90% of all recipients do not maximize their benefits. They have no clue what their options are. Hey, Jim, I do want to go over the surviving spouse three-legged stool. Okay, go for it, big guy.
Sure, and they have options other folks don't have. Of course, as we mentioned, you can file for survivor benefits as the widows and widowers as early as age 60. You will receive 100% of the benefit, 100% of what the deceased was receiving or eligible to receive when you reach your full retirement age. For many, that's 66, but it is working its way up to 67. You can also, as we mentioned, take your own benefit as early as age 62 or maybe wait till age 70. So with surviving spouses, you can take the survivor spouse at 60, switch to your own at 62 if it's higher, but you could also wait, and you can wait till your full retirement age. You can even wait as late as age 70, earn your delayed retirement credits, but still in the meantime, you have money coming in. Now, if the survivor benefit is the higher of the two, you can take your own at 62, take a reduced retirement benefit, and then at your full benefit age, switch to the survivor benefit and still get 100% of what the deceased was receiving or eligible to receive. The one thing that people need to keep in mind when you're thinking of those is that the earnings test does apply. So if the individual wants to file for the survivor at 60 or their own at 62, if they're still working, they're going to have to be aware of the earnings test, but they still have those options available. So those are options that people with surviving spouses in their past really need to think about. If you can take the lower benefit in the beginning to get a higher benefit later, overall you're going to be much better off.
I like to talk about the services that our firm offers. We provide Social Security consulting services. When you come across a client that may not, that would like to review their options, we can run an analysis for them and schedule a consultation with Jim Blair. And you can see our fee is $545. We also provide Social Security education and offer the National Social Security Advisor Certificate. And we offer classes 3 ways: live in-person classes, live webinars, and taped on demand. And the tuition ranges between $795 and $1,095. We offer the gold standard of support. You call us with questions or you email us with questions. And also you could attend our monthly webinars. And we are definitely an excellent resource for you, for advisors like you folks on this webinar and your clients. You see my contact information down below. Phone number 513-218-8505. And my email, mkiner@mypremierplan.com. And before we turn it over to Betty, I'd like you to connect with us on LinkedIn. Go to your LinkedIn profile, type my name, Mark with a C, Kiner, and send me a connection request. I'd love to connect with you. We're trying to get up to 6,000. We have about, I think, 100 to go between now and the end of the year. So
All right.
we're ready for questions.
Thanks, Mark. You know what? Before we get into questions, I would like you to go back to your couple of slides on the benefits. You know, just quickly, let's spend a couple minutes on the Social Security benefits for couples and singles and divorced. You did surviving spouse, because you know, as
Okay.
financial advisors, we need to understand what the options are
Sure.
for those particular situations.
Okay. So here's the three-legged stool for a married couple. We already kind of went over some of this stuff. One spouse waits to age 70 or someplace between age 66 and age 70. That allows us to maximize surviving spouse benefits. Leg number two, you want to coordinate spousal benefits and understand situational Social Security. If you have a married couple, there might be 5+ years difference in age. Then maximizing surviving spouse benefit probably makes the more sense. If you have a married couple where one was born by 1/1/54, then the restricted application needs to be on the table. Married couple that might have some children that you want to factor in, kids up to either age 19 or 18 or 19, a child may be eligible for benefit once a parent begins their own benefits. And also you may have a married couple that might be a little closer in age, and so maximizing surviving spouse benefits may not be as important. And what if the wife is older than the husband? Then we're probably not even looking at maximizing surviving spouse benefits. Jim, I'll let you do number two, please.
All right, so single folks also have options. They can file at 62, full retirement age or 70, or really anywhere in between. But a couple things that they need to take into consideration. One is that if they file before their full retirement age, the earnings test is going to apply. And depending on the amount of their earnings, it may not be worth them filing, at least until full retirement age. Waiting from full retirement age to 70, the earnings test no longer applies, and they're going to earn delayed retirement credits. They'll see an 8% per year increase. Is it worth that? Remember, the difference here, you're not trying to build up any type of survivor benefit, and understanding that when you pass away, your benefits stop. So how important is it that you have a higher benefit? It's hard to say, but sure, you can wait till age 70, get anywhere between a 24 and 32% increase, depending on your full retirement age. But then if you only lived to age 72, you certainly didn't hit that break-even point. Not that you'd know or care, but you know, it's something you definitely need to take into consideration. Now, if you were part of Ethel's family and everybody lived into their hundreds, yeah, waiting till 70 might make a lot of sense. But still, there's never any guarantees.
Thank you, Jim. Appreciate it. Thank you, folks that have already sent me LinkedIn connections. I appreciate that too. Married couple, divorced folks, you can collect off your ex-spouse if the ex-spouse is alive or deceased. If to collect off of an ex-spouse and you've been divorced for less than 2 years, your ex must be receiving a benefit. Divorced for 2 years or longer, your ex does not need to be receiving a benefit. And finally, if you were born by that magic birth date of 1/1/54, then you can file a restricted application, collect a spousal benefit off your ex, while at the same time your benefits are growing, earning those delayed retirement credits. All right, Betty.
All right.
Jim already did a good job with the surviving
Yeah,
spouses.
you did. Yeah, you guys covered that. So, great. Well, thanks so much, you guys. And we do have some questions. So let's dive in here. I have a sister-in-law who was widowed, and she's collecting on her deceased spouse's benefits. And now she'd like to get remarried. Will that stop her benefits?
The good news is, I guess since she's collecting the widow's benefits, that means she's past age 60. And if normally you're supposed to be single to draw widows and widowers benefits. However, if you remarry after you attain age 60, they will disregard the marriage. So if she's over 60, she can remarry and continue to receive her widow's benefit.
That's good news. All right, good. For someone who is divorced and they collect on their ex's benefit, is there a, can they delay benefit and continue to get delayed retirement credits, or is there a cap at a certain age?
Jim, I'll just let you handle the questions, okay?
Okay. So if they were born by that date we talked about, January 1st of 1954 or earlier, then they could just draw the divorced spouse benefit and save their own until age 70. If they were born after that date, then to draw either as a divorced spouse or even spousal benefits, you must take your own benefit first. Something called deemed filing, which requires you to take your own benefit first, then if there's an additional benefit. But if they were born by that date or earlier, 1/1 of 54, then yes, they could do the ex-spouse benefits, the restricted application now, and wait till 70 to take their own.
Okay, all right, very good. I've heard there's a credit for women who stay home to take care of her children. Is there any truth to that?
Well, just not really. It's they've talked about that, but nothing has been passed. It's just basically the spousal benefit. So if you never worked a job where you paid into Social Security tax, say you were a stay-at-home mom or dad, you're eligible for 50% of your spouse's full retirement age benefit when you're full retirement age. If you take it earlier than that, it's reduced for age, but that's right now, that's the only thing you would be eligible for.
Okay. Another question, what if a surviving spouse is 70 and she worked for a county and she receives a monthly pension? So let's maybe get into the weapon GPA stuff, I'm not sure. Is she eligible for 100% of her deceased spouse's PIA? Because this is county versus state, so how does that work?
Yeah, if her job, she didn't pay Social Security tax. And in Ohio, for instance, in Ohio, the county employees do not, then it's based on 100% of his, but then it's going to be reduced by 2/3 of the amount of her non-covered pension.
Okay. And one last question, if a public employee takes a lump sum for their pension benefit, how do they calculate their WEP? Is it spread out over a lifetime?
Well, it is spread out over a lifetime. The first thing that Social Security is going to do is ask, had you not taken the lump sum, do you know what your monthly pension would have been? And if you know, well, if you don't take the lump sum, you get $2,000 a month, or if you take the lump sum, you get the lump sum plus $500 a month. They'd count the 2,000. If you don't know, they can't give it to you. You have no clue. What they'll do is they'll take your lump sum and divide it by your life expectancy, and they'll divide it by the number of months in your life expectancy, and that's your monthly benefit amount. And they'll use that to determine either the windfall elimination provision, which is what applies when you're eligible for the non-covered pension, plus your own Social Security benefit, or the government pension offset GPO, which applies to survivor benefits, spousal benefits. And that's how they determine the number that they're going to base all that off of.
Okay. Okay, and one last final question. What is the most, great question for wrapping up, what is the most common mistake people make in drawing Social Security, and therefore then why they need advisors to help them? Go ahead.
I think people file too early. One of the big things that people don't understand is that if I take my benefit at 62 and I'm the higher earner, that not only reduces my benefit, but it reduces my spouse's benefit if they survive me. And one of the things I recall from taking applications, you'd have a couple, the income is fine, one of them would pass away, and you tell the surviving spouse what they're going to receive, and they'd say, but that's not enough, because obviously you lose some of the income, but your expenses aren't cut in half. So You need to plan for that in advance. And the other thing I would just say is Social Security is a lifetime benefit. Taking benefits at 62 versus say full retirement age, it's about a 12-year break-even point. And people are living up to 6-7 years on average past that break-even point. So you need to know that once you take a reduced benefit, it's always reduced.
Right, right. Well, very good. Thank you, Mark and Jim, so much. And your experience and your insight into all this is just very, very helpful. And we appreciate the work that you guys do.
Our
So,
pleasure, Betty.
and now if you can flip over to that last slide so we can wrap up here to let folks know our next coming couple of presentations are this Thursday. We also have a live presentation, New Horizons in Estate Planning with Steve Parrish, who is the co-director of Retirement Income at the Retirement Income Center and adjunct professor of advanced planning at the American College. And on Monday, June 21st, we have a rebroadcast of 21st Century Longevity, Health, and Wealth, Preparing for Health Risks in Retirement. So thanks everyone for being here with us today. And you will be receiving an email with your certificate of proof of earning 1 CE credit. Jim, Mark, and myself and the rest of our team, thank you for participating today. Have a wonderful rest of the day, and we look forward to being with you again in the near future. Take care.
Bye.
Goodbye. Thanks, everybody.